I think Melbourne will be our best performer over the next 10 years, and I actually think it's going to be the best performer by quite some way. So you'll see just here really just kind of what's going on here with Melbourne. This is the, again, CoreLogic 30-year report, and what they've done here as well is they've showed the top capital city SA3 regions over the 30 years. So SA3 regions, it's not necessarily council regions only. They do go across some, but because so Sydney does go across a few, Melbourne does as well, but it's just basically broad regions. It includes usually somewhere between 5 and 10 or 12 suburbs or something like that. But you'll see here Melbourne just dominates it. Yarra, Melbourne City, Boroondara, Maribyrnong, Port Phillip, all there, close to 700. Even Brunswick, Mornington, all of them, Essendon, all those areas, like really good areas to buy. I mean, above 700% growth, 4 of them. That is incredible. Like, those numbers are insane. So where do you think I buy? Like, the predominant suburbs I buy in all of these areas that you can see here. Port Phillip as well, and all the top of Hobson's Bay as well, which performs the same as Maribyrnong. Hobson's Bay doesn't show as good because Hobson's Bay is a much bigger region that isn't completely landlocked, but the particular suburbs I pick will perform the same as pretty much Maribyrnong. Melbourne City doesn't have any houses left, so that number's probably irrelevant. Yarra I buy in all the time. Boroondara, yes. Port Phillip, yes. All good areas as well. Best areas to buy. I mean, I can't see how you lose money buying these areas when it's done so poorly over recency as well, when you know it's going to do so well over the long term. So, just something to consider. Like, that's what happens long term with these areas. Mind you, Melbourne did next to nothing between the COVID period of the start of 2022 when this actual table was put together. So, I mean, if you want to, just say, oh yeah, this includes a part of COVID, Melbourne did next to nothing. These areas it's pointing out did next to nothing. The part that actually did best of Melbourne was Bayside, and none of that's actually included in here, funny enough. So, yeah, like some parts of the Bayside I like purchasing, don't get me wrong, but this shows you really the good areas to buy in, undoubtedly. So look, really, why is it going to be the best performer? I've showed this in the past, but it was a very good graph that I like explaining to people because people don't understand it. So these are basically markets, again, they run in cycles. It's not completely linear. You generally have a larger scale cycle with 2 smaller cycles within it. So you'll generally have a longer, you generally have a longer stabilization period followed by a shorter boom, then a short stabilization period followed by probably a little bit of a larger boom, then a longer stabilization period again. It goes around in circles, kind of like that. So the 3 parts you can see here are your downturn and stagnation. So you can see in the early 90s, you had your 92 to 97 stagnation period kind of there. That was your longer stagnation period. Then you went to your 2007 to 2012. Yes, it grew a little bit, but not much. And then you have your longer term stagnation period, which was now, which again, it didn't grow very much, but it's your longer term stagnation. So it didn't do very well, but that's basically kind of what happened there. So that's kind of what's happened. Then within that, you've got your upturn and boom phases. So you got your 97 to 07 there. Which you can see did quite good there. Then you also got your 2012 to 2017, which is quite short and sharp. And then I've got 2025 to 2030 question mark. Look, the reason I've got 2030 question mark there is because in this actual episode and what I'm explaining here is it is going to run for a number of years. I don't know how long it's going to run in saying that because I'll get in this later in literally the next few slides, but there is a variation between where it goes up, where it sort of has a little bit of a slowdown, and then where it really kicks off. And there's a buffer period between each of those, which I'll explain in coming things. But Melbourne is really due for the next boom. It is our most consistent performer, and it has performed the worst over recency. So I can't see it doing badly at all in the future. It is going to do extremely well, and it's going to run for a number of years. I'm telling you, it's not going to be a short cycle. It's going to run for a number of years, 100%. So I'm going to now get into basically an actual graph I've actually put together myself using basic econometrics data, correlation, everything I do there. And I just want to give you some insights into just a few rules about what I'm going to do here. So first things first, the boundary of the existing Melbourne, I'm assuming is maintained. If they move this out right out to past Melton, right out past the Dandenong Ranges, it's going to change the capital growth. So wherever the Melbourne City is today, Greater Melbourne. That's what I'm assuming they are doing. I'm only counting houses here. I'm not counting anything else. I'm actually only counting detached houses. I don't care about any other dwellings. So keep that in mind as well. And I'm assuming the government continues to do what they do, which I'm telling you they will, but I can't say that definitively because obviously I don't control the government. And that is they'll continue to money print their way out of shit, which only increases prices of everything. They'll continue immigration, which whether it's Labor or Liberal, I'm telling you they'll continue to do that. They'll continue to have centralised wealth, so the government controls all the wealth, which is in all the CBD cities. It's going into almost like a communism phase in some instances, but I mean, a communist, not communist, but a capitalist country that is kind of where the government's kind of going towards a communist route. I mean, like the UK is, for example, generally the cities get even more expensive. It's just what happens, and you'll continue to have centralised businesses and jobs. So, I mean, I don't really care what the government kind of says about, oh yeah, we're getting jobs here, there and everywhere. Yes, there are in probably the Sydney Basin and probably Geelong as well. But I mean, outside of that, watch what they do, not what they say. It's full of shit. It's just not the truth. So just on what I'm about to show everyone, just keep in mind that these areas here that I am actually explaining and showing to everyone, this is what's going to happen, assuming these things all stay the same, which I assume they will. The first two things are going to stay stagnant because if you take in what I'm saying, they will. The third thing, I'm 99% sure it'll stay the same because it's just what the government does. But anyway, what will really happen here is Melbourne will first of all go up. It'll then stabilise, and then it'll really go after, and then back to sort of the stabilisation and the downturn and stabilisation phase. That's what I expect to happen. And now, this might look very sort of complicated in how I've drawn it, but I'll show you what I'm looking at. This is basically what I've done. So if you look on the bottom right there, you'll see the key series. So I've basically done a high series, a median series, and then a low series. So this is what I expect to happen in Melbourne. I know I've previously said 90 to 120% growth, and this is how I basically got to it. So really, at the time of actually making this video, Melbourne had a median house price, including that area, of about $917,000 at the time. Now, if you say it's more, all you have to do is just do the percentages and say it's going to go up to that. But at the time, on CoreLogic and also home price data, that's what it came out at. So that's where I started at. Now, all I've done is I've basically used long-term market cycles, long-term correlations, long-term strategy, long-term income demographics, gentrification, international demand, and everything. I've basically put it through a few econometrics tests, and I've actually basically from there, all I've done is I've actually populated it based on what I've got. This was drawn based on that data, so that's kind of what I've got here. So you can see here, the high series up 2.017 million. By that is, so 10 years from today, so it's by 2035. Middle series or median series was 1.88 million, and low series I had at 1.72 million. So even if you want to say I'm wrong, or even if you say I'm slightly wrong, but it's going to be lower than the low series, you're still probably above, 1.7 million from 917,000 today. So I don't really know how you can go wrong there. But anyway, what I want to get into here is what I expect actually to happen. So there's 4 key parts of this that I expect to happen, and I'll give you the standard deviation as well off each of them, because what can happen here is what I've done here is just over 10 years, but there is a buffer between basically standard deviation of each cycle or each part. Now, what I'd say here is I'm going to give you the first 3 because I'm saying until it hits the downturn and the slowdown, okay? So first of all, you're at the beginning of the cycle. Now, the standard deviation of this will be something between, I'd say, 6 and 12 months. It'll be something like that, your standard deviation of this, right? Something like that. Now, what we have here is, first of all, you've got more liquidity coming into the market because you've got interest rates dropping and money printing continuing and government spending continuing. And then you've also got the incentives, which is like the 5% deposit, which is the government-backed subprime mortgages. But anyway, the government will have to continue to back that. But so that's the key things you got in this cycle. And naturally, with liquidity and also, should I say, incentives in the market, you'll have natural growth. Now, even the low series here has growth, and I'm telling you, even if it does nothing, simply because you're going to have these incentives coming in, developers will just price up their stock, more people come in, it's just natural. It will happen even on a low series. It's undoubtable this will happen. So don't get confused over that. It's going to happen. So look, you can see there, like your minimum growth even over the next 2 years is probably minimum probably 15%. And you've got the higher series right up to about probably 25 there or something along the lines of that. So that's what I'm kind of expecting in that early stage of the cycle. Surprisingly to what a lot of people don't understand, and don't kind of know, I actually think we, in the late sort of 2020s, we are going to get a GFC style event or slowdown kind of event. That's something like that will happen. So what I've got here, and just to break down that for everyone here, is that the more well-diversified cities here will be less affected by it. And the reason for that is because generally their jobs are more required in the market, and they always will be there. Dependent late city cycle cities will be badly affected. So this is when I actually expect your cities like, for example, your Brisbane's, especially your Perths and Adelaide's, and obviously regional centres around that, to really completely slow down and maybe even go through a bit of a downturn as well. Look, your standard deviation over this period is again probably similar. I'd say it's probably around somewhere between probably 6 and 12 months either side. So that's what I'd say in terms of standard deviation. So yeah, that's kind of what I'm predicting in kind of that kind of period. That's your set number 2. Look, Melbourne and Sydney particularly, and the surrounding cities there, they may correct a little bit. So you can see my middle series has a slight correction there. My low series doesn't, because it'll just be too low price to correct. That's the reason. My middle series does, because basically there, people just follow the crowd, and it can correct. It's just generally how it works. So that's why it's my middle series. My upper series, it just kind of slows down but still goes up, because it's just people are still very hot on it. My third phase of it is your larger growth phase there. Look, this I expect to run for probably somewhere between, I'd say, probably 4 years, maybe 5, something like that. I expect it to be something like along the lines of that. Your standard deviation of this, however, maybe 1 to 2 years either side of it. It's just because sometimes it does very well in shorter periods, sometimes it's a little bit long. So that's the thing. So you'll see here, I've got a few points just here. You've got diversified cities will grow substantially. Melbourne and Melbourne surrounds will particularly dominate. So that's in Melbourne and Geelong in particular. They will absolutely dominate this period. I expect them to absolutely dominate this period. I expect them to be by far the best performers. You can see just the growth here I'm expecting of it. I expect Sydney Basin to do quite well as well, not as well, quite as well as Melbourne, but are still expected to do quite well in that time as well. Your finished cycle cities, so that's just going off point number 2, they will completely stabilise or lightly grow. So it'll be in their complete stabilisation phase in this period. So I expect them to be very flat or very lightly grow in this period. That's what I'm expecting to happen here. So as you can see here with the growth cycle, you'll see here really that you have, literally a large scale period. You can see the first period of growth and a little bit of a slowdown, then the second period of growth will be massive. It'll look like an uptrend line when you zoom out further on this, but this is generally what happens in a more, focused period. So this is only a 10-year period. So that's what I'm kind of expecting. That's your growth period there. That's about your 10-year phase there. Of growth. Then what you'll see is it'll peak and hit point number 4, which is your market peak downturn, then going into your slowdown, which is your stabilization phase. You'll have the Melbourne market slowdown and downturn will begin. Sydney Basin will be similar to that, so it'll underperform Melbourne, but it'll be similar because they correlate fairly similarly. Then what will happen is your smaller cities will end the stabilization phase and begin the upturn phase over the coming years. Funny enough, your eastern cities like your Sydney and Melbourne generally correlate, and they anti-correlate or go against basically the correlation of your other cities. So if you're smart here, this will be the time where you get back into your Melbournes and Perths, not your Melbourne, sorry, your Perths, Brisbanes, and that kind of, obviously still buying the right fundamental areas, but this would be the time to get back into them. That's just the truth of the matter. So really, this is a really good time to pick it. Your standard deviation of this is about 6 to 12 months either side of it as well. So Again, if you were to take the short end of this, I mean, it could be a lot earlier. If you take the longer end, it could be further. But this is just how markets run. So to give everyone an idea, if you take the extremity of the standard deviations of either of this, you have obviously either side of it. So you got 12 months at the most of, should I say, the start. Then the second is also 12 months. So that is, should I say, 2 years in total. Then you'd have 2 years either side of, should I say, the main part of this, and then which would be 4 years. So that would be an 8 year difference between the whole run of the cycle here. That would be your absolute extremity of it, but you'd also have on top of that as well. It could go a lot sooner. So this could happen by, I mean, this could go as far as probably I'd say right out to maybe because you're still using the period. It could go right out to you maybe 2036 or 2037 mark, and this whole cycle could be done by 2031 to give you an idea. So, but this is the median basically time I think it'll take in the market. I think this will be, because Melbourne's a very, should I say, consistent performer generally. I actually think the actual period of this will be fairly accurate. I expect it in sort of somewhere between 2033 and probably 2036 to actually run exactly like this. But that's kind of what I'm expecting. I hope, like, this did take me a fair bit of work to actually model and do. So I hope everyone's really enjoyed this little segment in this, because this is really what I expect to happen. This is a breakdown of exactly what I'm expecting Melbourne to do. So the next phase of this, I'll actually get into the best regions to buy in Melbourne. I'm actually going to be very nice and actually give you a suburb in each of the regions to buy in as well.